From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, U.S. producer prices rise at the fastest pace in more than 3 years. As Wall Street awaits the first interest rate decision under newly minted Federal Reserve Chair Kevin Warsh. And PIMCO issues a warning, saying the credit loss cycle is now upon us. We begin with the big issue, the U.S. economy staring down hot inflation.
Core inflation in the U.S. still looks like it's on a trajectory that eventually should be okay for the Fed.
The U.S. economy is roaring, it seems to us.
The economy isn't as strong as actually the headline suggests.
The consumer is losing the capacity to absorb any additional shocks.
We will see weaker employment data this summer.
The Fed should not be looking through that.
The market will test Chair Warsh.
He has very few ways to argue that the Fed should be cutting rates at this point.
Cuts are off the table for the balance of the year.
The case can be made for a hike right now.
Hiking rates here isn't going to solve the problem of oil supply shocks.
I think it's more and more apparent that we're not going to get a rate cut anytime soon. I also don't think that we're going to hike very quickly either.
The safest thing the Federal Reserve can do politically and also economically, I think, is just to do nothing here.
All right, it is time for the chart of the week. We're looking at U.S. inflation because the past 2 days we got reads on consumer and wholesale prices for the month of May. CPI is the blue line here. You can see that it rose 4.3% year over year, so at a 4 handle. PPI is the yellow line. That is wholesale inflation, producer prices up about 6.5% year over year. PCE, the price consumption index, which has price consumer index, expenditures index, which has elements of the two, sitting at about 3.8% right now. These are headline numbers. They are not core. They do not strip out oil and food costs, which the Federal Reserve tends to do to get a cleaner read on inflation. But nevertheless, these are numbers that are higher than where policymakers would like to see them be. Now, sticking with monetary policy, the European Central Bank hiking rates for the first time with a stark warning on inflation.
We are beginning to see a broadening of inflation throughout the economy. And that is obviously in terms of direct effect, but also in terms of indirect effect. Not yet at this point in the front of the second round effects. With today's decision, we remain well positioned to navigate the uncertainty caused by the war. We will closely monitor the situation and follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance.
Bloomberg's international economics and policy correspondent Michael McKee joins us now with more and with chart in hand. So, Mike, let's start with the ECB. It is the first of the major central banks to react to higher prices due to the ongoing war. But the argument can be made that by raising rates, it doesn't really address the problem, which is this oil supply shock.
Well, in the ECB's case, it's more a matter of confidence and letting the markets know that they are on the job. They have just the one mandate to control inflation, and they are concerned about the second round effects. That's similar to what we're seeing with language out of the Bank of England, which will make its decision next week, and traders are betting on a rate increase there. In the U.S., though, we're on hold because our rates are a little bit higher already, and at this point, most members of the Fed think they are restrictive enough to hopefully push back against inflation unless it really catches on.
I guess the bigger worry here is that inflation is broadening out, and it's not just limited to energy. It's going to other parts of the economy. Where do we see this or not see this, actually?
Well, of course, we see it in energy. Gasoline prices were up in the PPI by more than 23% over the last month, and food prices also rising. And those are the politically important things because that's what American consumers see every day. But we're also seeing it in terms of things like plastics, pharmaceuticals, other things that use energy are starting to go up in price. And what the Fed is watching is to see whether inflation expectations start to rise because people think it's just not going to go down again. And my chart looks a lot like yours, Scarlett, but it's a different chart because it's looking at inflation expectations. And you can see the 1-year inflation expectations and the 5-year inflation expectations from the University of Michigan have both gone up dramatically recently. But Wall Street still relatively sanguine. That's the yellow line there. That's the 2-year inflation swaps view for what the inflation premium is. And at this point, the break even is still headed down. It's still in the 2s range. So if we see that turnaround, you'll probably get more of a reaction from the Fed. But for right now, the consumer's worried. But the Fed can take some comfort in the fact that the Wall Street traders are not.
All right, good stuff. And I appreciate your pointing out the perhaps inconsistencies there in inflation expectations across different measures. Bloomberg's Michael McKee joining us. We'll see you on later this hour. Let's use that as our starting point with our roundtable. Nisha Patel is SMA Fixed Income Portfolio Manager at Parametric, and Guneet Dhingra, is Head of U.S. Rate Strategy at BNP Paribas. So, Guneet, let me start with you because you have a bold call. You see the Federal Reserve reversing the 3 insurance cuts and starting in December, hiking rates and maybe going past 1 rate hike, perhaps stopping at 3, perhaps more. What do you see happening between now and, say, year end that would prompt the Federal Reserve to start aggressively hiking rates?
Yeah, so let me start by saying that the inflation expectations point that we just discussed is extremely crucial to why the Fed will need to react to this inflation upsurge. We all know inflation has been higher than target for at least the last 5 years. But the bigger problem has been it's a series of what might be called transitory shocks are now starting to seep into inflation expectations. The surveys are pretty clear. The University of Michigan survey pretty obvious that inflation expectations, short-term and long-term, are going up. But the problem is the break-even market, I think, is a malfunctioning fire alarm. I think the problem is the break-even market is not reacting to the actual inflation risk. It's reacting more to the trading conditions in the rates market. So in the work we have done, break-even should be higher by about 20 basis points versus where they are if it truly reflected the inflation risk. And then if you couple the break-even level with the surveys, the anchoring, I think it would be pretty clear to the Fed that inflation expectations are on the rise and in the wrong direction. Add to that, finally, the point that unemployment rate is also trending slightly lower. Also tells you there's more inflation risk in the pipeline. That's why we think 3 hikes beginning in December this year are going to happen.
It's definitely an out of consensus call. Nisha, you are thinking that the Federal Reserve wants to maintain optionality. It'll probably drop the easing bias next week. How do you think about inflation expectations? Mike just showed us that chart that showed consumer-based measures are different than market-based measures.
Yes, and I think that's a key distinction here because why I think the Fed will want to keep that optionality. Again, markets pricing in further rate hikes is one thing. I think the Fed is going to want to really communicate while a hawkish hold the optionality and not necessarily signal the hike. The key reason is that inflation is kind of the key component here. And there's two ways to look at it. There's a scenario where inflation continues to seep into services and goods, and perhaps we haven't reached the peak. If that is the case, to Guneet's point, perhaps you do start to see more of that positioning towards a hike. However, the other scenario is that does this at some point create a scenario where you just have a softer consumer in the back end of this year, right? So does this get displaced with more of a disinflationary approach if we have peaked in terms of inflation? And again, I think the Fed, at least for next week's meeting, cannot be sure of either direction, which is why that optionality is going to be key and is likely to be kind of a key component of this, a little bit more of a hold for longer, watch and see for at least for the next 2 meetings, in my view.
So, Guneet, is the market wrong in thinking that that 4.2% print that we got for CPI is the peak and things will kind of ease from here on out?
Yeah, so I think the 4.2 headline print might actually be peaking here because oil prices obviously are going to decline on a year-on-year basis. But the problem is core inflation typically lags headline inflation. And I know in New York, we're all excited about the Knicks sort of going for this historic championship after 1973. I think the 1973 parallel also comes to inflation, because back in 1973, we had oil prices going up, headline CPI rose sharply, and then core CPI followed 6 months later. And of course, what did we get? Rate hikes and a much higher bond yields.
So I guess to put this into perspective here, what do you see happening, Nisha, next week? What do you see Kevin Warsh, how do you see him setting the table for that maximum optionality? I mean, he can't lock himself into any kind of position because he's got a president who's watching him. He needs to kind of perform and deliver what the president wants, which is being able to cut as needed.
Yes, which is why I think this optionality component is so key. And so, this is going to be a meeting about establishing credibility. And so perhaps, the appease to the hawks on the committee is by dropping the easing language. But again, not necessarily creating any further language to instigate that the next move is going to be a hike. So I think, again, that optionality could appease both the administration, perhaps the pressure, at the same time, really kind of appeasing the hawks that are on the committee. Again, this is such a big meeting for Chair Warsh that first this is going to be, I think, just for the market in terms of the credibility, the tone, the communication. And I imagine there would be no immediate surprises. So again, I go back to perhaps there's a way to make both sides happy, at least next week. And I imagine that in some ways that is what Chair Warsh will try to do.
Okay, threading that needle, essentially. Guneet, let's talk about the buyer base for U.S. Treasuries. It used to be tracking central bank flows, but you say it's now shifted to another group. What is that group and what did their flows depend on?
Yeah, so I think one thing that's very visible, if you look at the official data on Treasury holdings, particularly in overseas buyers, is the net buying, particularly since Liberation Day, has not been done by the traditional buyers in Asia or even LATAM or even Europe. 90% of the net buying in the last 12 months or so has come from what you might call financial centers. Think of Luxembourg, think of Cayman Islands, think of the UK. What that means is the buyer base is no longer yield sensitive. They are not stepping in the bond market because yield levels are 5% on the 30-year bond. They would come in if they felt comfortable with the macro situation. They would come in if they felt comfortable with inflation and with the Fed. We don't think those conditions are there yet. So that buyer base being absent keeps the bond market more vulnerable. And that's why we think yields are going well above 5% on the long bond.
Do you see that, Nisha? Do you see this differing buyer base creating more volatility, especially at the long end?
We do, and I think it depends on which market you're looking at. So at Parametric, right across a variety of fixed income markets, you're seeing this in the Treasury market that is seeped into other markets because, again, the main story is that clients are being very wary of taking on duration. Now, on the flip side, I will say when you have the buyer base pull back, you do see a component of just higher, and more attractive yields over time. So then this really becomes about, creating some sort of a quality bias and really thoughtfully adding duration. If to Guneet's point, if we do see more of that shifting to, hey, the Fed is going to hike, we do see that later on this year, there's no doubt in the short term then you will see yields possibly go slightly higher. But I would make the point then that can possibly create even a better entry point. And timing this is always so difficult. So, yields are higher on an absolute basis. I think there's a thoughtful way to add duration. And I go back to especially our client base who are looking for a hedge, when you have valuations as high as they are, they're possibly sitting in cash. Clients are finally getting paid to step out of cash and add some duration in fixed income.
Speaking of hedges, Guneet, that you were talking with us earlier this week about how there are parallels to 2023 when stocks were also on a tear and when they're also being led by big tech. What happened then is now instructional for how to hedge against a correction or maybe something even more dramatic for stocks. How do you think about that?
Yeah, so I think going back to 2023, one thing you've found in 2023 in the in third quarter and fourth quarter is that when equities had massive gains from late 22 to mid 23, a lot of investors were thinking about what can go wrong, what can change here that kind of quote unquote spoils the party. And the risk at that time was bond yields could keep going up. We've seen this inflation driven correlation in the last 5 years. We think a similar risk exists today, where if bond yields keep going up, that could effectively become a hedge to locking in your equity market gains.
All right, good stuff. We got to leave it there. Thank you so much, Nisha Patel of Parametric and Guneet Dhingra of BNP Paribas. Still ahead on Bloomberg Real Yield, private credit fund redemptions remain elevated. Hear why Marathon Chairman and CEO Bruce Richards is saying worries around software are warranted. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for a moment of interest. Earlier today, Bruce Richards, plural, CEO of Marathon Asset Management, sat down with Matt Miller. Richards warned that managers could have too much exposure to software.
So just big picture. So JPMorgan, in their most recent report that was released yesterday, puts the direct lending business here in the United States at $2.1 trillion in size. Just to level set, there's been about $18 billion of redemption requests. 18 billion of redemption. There's 40 billion in redemption requests. 18 billion has exited.
Got it. Okay.
So 18 billion, divided by that's $2.1 trillion is a sliver. It's less than 1%.
Right.
And so while that less than 1% wants out, rightfully so, because a lot of the managers have taken, as you just indicated, taken way too much software exposure within their BDCs, within their open-ended structures. That's problematic. Number one, there's been a complete new revaluation of what a software business is worth. We don't know which one of the software companies are going to make it through in the next 3 to 5 years, and it's too early to tell what the business is actually worth. So how can you decide how much debt can support that company?
For more on this, let's bring in Bloomberg senior credit editor James Crombie. So James, Bruce Richards says it's too early to tell when it comes to software companies, but we now have had 2 quarters of private credit funds gating, limiting redemption requests. So that suggests that there's going to be more and more quarters to come of redemption requests.
Yep, we're going to see it piling up. It's Groundhog Day for private credit. Every quarter, probably for the next couple of years, we're going to get massive requests. We're going to get gates coming down at 5% because the funds are designed not to have a run on the bank because they have to lend long term.
But for those BDCs, business development corporations, that do need to give some of the redemption requests back, they're forced to sell loans at a discount to give that cash back. They tend to sell the best stuff first in order to get as much money back as possible. What do we know about what that has actually looked like?
So far, they just have, as you said, sold the good stuff, and there's going to be more pressure as this goes on to sell more and more discounted loans. We know that there are buyers. And not just BDCs, but also CLOs, the collateralized loan obligations, which are a big part of the leveraged loan market. They also have a big exposure to software. They are also going to be selling loans.
So CLOs, I feel like everyone talked about how great they were, how they were like kind of the perfect instrument. What happens? Who feels it the most if CLOs start faltering?
Well, the equity tranche will take a hit first, then there are lower rated tranches that people have been yield chasing in for a while. Those tranches will start to take losses. I mean, the AAA tranche that most people are in, that has done very well even through crises. So, people think that they are going to be insulated there.
One thing that has really caught my interest is this idea that private credit problems have kind of spilled over into other parts of the market. They spilled over into private equity. You saw Partners, which of course has its own issues, gating its private equity fund. Is this because of liquidity concerns? Is this because of valuation concerns? A combination of both?
I think, well, there's a general fear of the unknown. Everyone wants out. What do they know that we don't? People hate gates. Investors hate gates. Now they can't get their money out. That generally just feeds on itself. Yes, there is a problem with software. Yes, there is a problem with marks on some of these loans. There was a huge software bust that lost $5 million for Thoma Bravo, Medallia. That's very concerning. And all of this stuff just feeds on itself.
People hate gates, but I mean, the defense for the industry, of course, is that investors knew that they were putting their money into less liquid instruments. That's what they agreed to in order to get higher returns, higher yields.
When you say they knew, I would question that. They may not have read the prospectus. I think we're in a time when there's way too much money chasing not enough credit assets, and people aren't really asking that many questions. They're seeing a high yield and they're buying.
So this is the lesson of democratizing access to private assets, right? I mean, the industry has been pushing to allow more retail investors to buy into these assets that are difficult to sell and are meant to be held for the long term, not for a couple of years.
Yeah, I mean, if you look at the growth expectations, I think Apollo put $40 trillion number on the size of private credit. That really relies on a huge amount of retail money coming in. This retail base is scared right now. They lost the trust. It's going to take a long time to get that back.
So my next question is, because we're going to be talking about public credit shortly, to what extent is private market stress in private credit, in private equity? What does that mean for public credit markets? Does it drive money to the public credit markets?
I think it does. There is a diversion back into liquid alternatives. PIMCO and other big funds have said that, why bother going into something that is opaque, that is, very risky potentially, and cannot be traded when you can get very good yields right now in public credit. That means, liquid bonds and loans, 5% yield on an investment grade bond is very attractive right now. So why do you need to do the extra work? That will push money back into public credit. That will tighten spreads even further. They're already at near all-time lows. That only makes them tighter.
All right, well, we'll see how that all plays out, especially as companies look to take advantage of that as well and raise more money to fund all that AI infrastructure build out. James, thank you so much as always. James Crombie of Bloomberg News, and you can check out his columns on Bloomberg.com. And you can also check out his conversations on the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Now, still ahead on Bloomberg Real Yield, we will turn to corporate credit as promised. Herr, CIO of the U.S. Global Fixed Income Currency and Commodities Group at JPMorgan Asset Management, joins us next. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. We start in U.S. high grade. At the moment, Chinese tech company Tencent with the biggest sale, totaling almost $2.5 billion. And I say at the moment because Citi is also in the market today with a new benchmark 4-tranche deal. We'll see later today how that shapes up compared to this week's leaders. Tencent, not the only one selling debt outside of his home country. This week, Amazon raising 14 billion Canadian dollars, the largest corporate debt offering on record in that currency. Amazon also agreed to a $17.5 billion loan as the AI borrowing frenzy just keeps rolling on. And Europe's primary bond market recorded its second busiest day on record on Tuesday, with more than 58 billion euros raised. January 7th of this year remains the busiest day ever. And sticking with credit, Fortress co-CEO Jack Newmark spoke at Super Return about concentration risk.
When people think about credit, they want diversification, they want good portfolio management. And over the last 10 to 15 years, there hasn't been a big difference in managers, and you could over-concentrate your book, you could take certain risks, and it ultimately didn't show through in the returns because we had such a benign credit environment. I think now the world we're heading is going to be one where there's different return profiles for different credit managers, and some credit managers are going to have to justify the fact that they got over-concentrated in certain sectors.
Let's dig into the credit market. Let's dig into concentration risk with Herr, CIO of U.S. Global Fixed Income Currency and Commodities at JPMorgan Asset Management. Great to see you here again.
Great to be here, Scarlett. Kind of fun to be on the second half of the hour. I haven't done this before. Usually
I appreciate it.
You got me masquerading as a macro PM.
We have you doing everything. I want to go big picture first because PIMCO put out an interesting note warning that the credit loss cycle has begun. We have a quote on it. They said that the default cycle is reasserting itself, and we expect significantly higher losses in lower quality credit, such as leveraged and private direct lending. It says the tight spreads in investment grade and high yield clashes with an uncertain macro backdrop, and they see this as a sign of complacency. What do you think?
So there's a lot to unpack there. I did read that article on Bloomberg, and it was an interesting read. I think there's a piece of it with which I agree, which is dispersion in credit markets. So I think if you look right now, and actually I'm going to take a step back and talk about equity markets. So you see the returns that we've got in the equity market, 10, whatever it is right now. Historically, high yield has put up 50 to 60% of those returns, and actually high yield's only yielding or only returned year to date a little over 1.5%, whereas historically it would be up more like 5 or 6% at this point. But if you look underneath high yield, what you're actually seeing is significant dispersion, and what you're seeing is underperformance in lower rated credits. So I think that's a really noteworthy trend. So that's the first piece of it. So I think I'm going to agree. I expect an environment in which we have greater dispersion, and security selection is going to be more important. The piece that I think is a little bit more difficult and a little bit more nuanced is they're talking about difficult conditions coming. But if you look at first quarter earnings, if we look at the investment grade universe, you saw, 5.7% revenue growth, 6% EBITDA growth. And if I look on an S&P 500 type level, you've seen 29% earnings growth for the rest of the year. That's not really an environment that suggests a credit cycle or distress.
So let's pick up on that dispersion point. We have a chart that shows how investors now require 6.4 percentage points of extra yield to own CCC credit over higher rated junk. That is actually the largest premium in 14 months. You talk about how it's all about selection, security selection. Which sectors does that opportunity show up in?
So I think the first thing to remember is that it's less about a particular sector and more about the individual credits. So when you think about the high yield market, well, when you think about the high yield market, it's much more similar to the equity market in that it's a particular credit that could be performing. I mean, it's like, there's no such thing as a bad bond or a bad credit. It's how much leverage you're putting on it and what the expectations are for cash flow. So I think that's the first thing. And actually, when we look at sectors, we see different markets in investment grade versus high yield. So in the investment grade market, for example, we've seen opportunities across our strategies. As a reminder, I run our Core Plus along with the team. So we see opportunities in investment grade and financials. That's not an area that we find particularly attractive in high yield because it's a lot of leverage to put on it. The other piece I think to remember in terms of dispersion, and it picks up on one of the points that I think it was John you had on there was saying, was that we've had a lot of issuance in the market this year. In investment grade, I think we've had $1 trillion worth of issuance before we hit the end of May. That's a record or near record amounts of issuance. And in high yield, issuance hasn't been as robust as the investment grade market, but it's been particularly concentrated. You've seen sort of the hyperscaler related CapEx or those types of issuers take it from 0% of the high yield benchmark to north of 3%. And that ties back, I think, to the original point, which is individual security selection, credit analysis, really what's most important.
You mentioned that high yield has been trailing equities when it comes to performance. Is credit leading equities?
It's a great question, and I'm not sure I know the answer right now. It's felt like equities have been leading, and what's been interesting in the equity market is as much appreciation as we've seen in equities and multiples where they are, multiples have actually contracted or improved because earnings have appreciated more than the stocks have appreciated. So what we've seen in the equity market is kind of an exponential growth. So you asked me about sectors. Pick a sector like semiconductors, tech, hardware type thing. You've seen those stocks appreciate in an exponential level. You don't see that level of appreciation in credits. You've got companies that have solid balance sheets. You know, we're at 2.5 times levered in investment grade, pretty stable, 4.5 times levered in high yield, again, pretty stable level of debt issuance. And the cash flow story is good, but there's not some ability for an exponential return in that. But that gets us back to why people buy bonds for the yield. Those yields are attractive, and credit fundamentals, as I mentioned from earnings, or if you look at, net debt's only up like 1%. It's a pretty benign environment. So I'm not sure which is leading which to answer your original question. And I think it's been more credit dependent and sector dependent.
So the exodus from private credit is not over yet. We were just talking about this with James Crombie. Business development corporations, BDCs, will continue to face a rough ride. Does that mean good news for public credit? What kind of contrast does that set up with public credit?
I think it's important to take a step back and remember or think about how we got to where we are. So if you go back to the origins of the boom in private credit, which has gone from essentially zero or was on bank balance sheets to now off balance sheets in the type of vehicles that you mentioned, it's now larger than the broadly syndicated loan market and larger than the high yield bond market. So that's a pretty significant growth that we've seen. But the origin of that growth was two things. Firstly, it was regulatory in that it was less attractive for banks to keep this on balance sheet.
Right.
So you saw this funding opportunity. And then the second one is really there's all this demand for private credit, but it was because yields were so low. If you go back, yields, 2022 yields are at 0.5% in 10-year treasuries. So people were really searching for yield. And one of the ways that people stretch for yield is they're willing to give up a premium, they're willing to pay a premium or to accept that for illiquidity. And I think if 10-year treasuries yielding 50 basis points, you're willing to take that illiquidity in exchange for a higher yield. And I'm going to agree with James Crombie in the point that he made. When you've got 5, 6, 7% yields in traditional fixed income with relatively low fees, that's now an attractive alternative for people. And I think that's the trend that you're seeing is this movement into public credit markets. I don't have to reach for yield to go down in quality. I don't have to reach for yield by giving up liquidity. And I think that's what you've seen.
When Bloomberg held its Global Credit Forum this month, attendees said that stagflation would be the biggest risk to credit markets right now. Do you agree with them, and how do you think that would play out?
So I agree that stagflation is the worst thing that can happen to bonds. So I agree with that. We're not seeing stagflation. Instead, what we're seeing right now is two things. The first is very strong underlying growth in earnings that we mentioned a few minutes ago. The second, we absolutely have seen inflation, although the prints this week have been in line or maybe even a touch softer than what wasn't anticipated. And what we're seeing this from, and I hesitate to use this word because it's fairly maligned from the Fed's use of it a couple of years ago. How'd you guess, Scarlett? But transitory. In this case, this is very much a supply-driven shock. We've got a war in Iran. We've had energy prices increasing due to that supply. What is it? We used to get 11 million, whatever number of barrels we were getting there. That's very much supply-driven. So we're not seeing a stagflationary environment. But should that happen, you're absolutely right. That would be a difficult environment.
Kay, always a pleasure. Thank you so much. Kay, Herr of JPMorgan Asset Management. Now, still ahead on Real Yield, with the sports world watching the New York Knicks play at Madison Square Garden, the area is also in the headlines because New York's Penn Station is set to get a facelift. It'll only take 6 years and $7 billion, so they say. And soon we'll learn how much federal money will be directed to that project. Details next. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are edging higher, with chip stocks leading the gains as investors weigh the latest developments in the Middle East against new inflation data showing producer prices climbed at their fastest annual pace in more than 3 years. In corporate news, Oracle's on pace for its worst day since January 2025 after reporting higher than expected data center spending, fueling concerns about the cost of building out AI infrastructure. Finally, the biggest IPO ever. SpaceX has attracted more than $100 billion in retail orders ahead of its market debut. The offering is expected to surpass Saudi Aramco's record-setting 2019 IPO, with pricing expected later today and trading set to begin on Friday. Those are your midday movers. I'm Nora Melinda.
It's time now for a Muni moment. New York's Penn Station gearing up for a renovation. The project involves adding train capacity, widening hallways, bringing in some natural light, and expanding the concourse, which means it comes with a hefty price tag. Here now to report on the story is Bloomberg's Michelle Kasky. And Michelle, anyone who's been to Penn Station would not be surprised to hear that there's a need to renovate it. Talk about some of the benefits to passenger rail riders in this proposed overhaul, because it's a $7 billion price tag. That is big.
That is big. That's a lot of money. But this is a major development. Penn Station does need this overhaul. And it's the busiest rail station in the U.S. And people have been waiting for this for decades. The last renovation was in the 60s. And what the riders will eventually see are these wider hallways, a lot more light, especially like you were saying before, the natural light, and a much bigger single concourse that they can move throughout rather than these sort of more individual specific concourses that have low ceilings and narrow hallways.
Yeah, it's always a mess when they post which track a train is coming in on, because then a whole bunch of people have to scurry over and run for it, as opposed to, say, Grand Central. I mentioned a $7 billion price tag. Who's going to pay for it? How long is it going to take?
Yeah, that's what we're all waiting to hear about. It's roughly around $7 billion. And what we're hearing is that in the next 6 months or so, there should be a framework in terms of where is this money going to come from. Amtrak officials have talked about how they really want to tap into as much as they can federal grants, federal loans, but they've also said that it will be important for New York and New Jersey and maybe even New York City as well to chip in here, because it's those residents that will be benefiting from this new station.
All right, so let the political fighting or negotiating begin. Michelle Kasky, thank you so much. She is our Bloomberg Muni reporter. We're going to stay with Munis because Matthew McQueen, head of Global FICC Micro at Bank of America, writes the following. Municipal issuance is up 6% year over year, driven by an uptick in both new money and refundings. We continue to see an active issuance pipeline heading into the second half of 2026. Matt joins us now for more. So, Matt, we've seen a lot of volatility in the rates market. How has that affected the muni market, if at all?
Well, thank you for having me. And to this point, I would say we've seen a lot of rate volatility over the past 2 months. And we've seen real minimal impact to the performance of the muni market, which is a little contrary to what we might expect. You know, historically, when we have the front end of the interest rate curve selling off as quickly as it did, we've seen a widening of muni ratios and a deterioration of investor demand, outflows from mutual funds and ETFs. Specifically, when we went back to Liberation Day last year, we saw some of those effects. We haven't seen any of that. The muni market continues to operate very efficiently and very robustly. New issue is coming to market. It's being met with ample investor demand. Secondary trading flows remain strong, and valuations, particularly inside of the 10-year point of the curve, remain, I would say, very investor friendly here.
And we talked about how there's going to be this massive renovation project at Penn Station. There are other transportation hubs that are in need of renovation as well. So there's a lot of need for funding there. How much demand is there for something like that? Or is it a case of people looking for specific projects in their home state?
So investor demand right now, I just think, given the yield that can be delivered in the municipal market, whether it's in the taxable space or in the tax-exempt space, is quite robust, especially given that a lot of these infrastructure projects, they're going to look to sell their debt out past 10 years, out to the 30-year part of the curve. That's where municipal ratios are actually as attractive as anything right now. I think that from an issuance perspective, you're going to see a lot of new issuance around infrastructure. Yep. And I think the borrower demand for dollars is going to be much higher, because if you look at over the past 5 years, construction costs have gone up a lot, input costs have gone up a lot, and then you look at everything that's happening in digital infrastructure, you're competing with all the construction related to data centers and supply chain around that. So the need for new money in the municipal market, I think, could be quite high over the next 3 or 4 years.
We also have a lot of states pushing through wealth taxes or some form of wealth taxes, or considering adding wealth taxes. What does that do in terms of stoking demand for munis in those specific states?
So generally speaking, some of the states that have had various noise around these wealth taxes, we've seen minimal impact to spreads. The market still continues to operate very robustly. We continue to see the ability to place debt, and a lot of these states that do have some of these backdrops, they're still functioning quite well from a credit quality and from a balance sheet perspective. If you think about the overall GDP of the economy, the overall economic performance, corporate earnings are quite good. So they're taking in still healthy revenue across the board. It hasn't put a lot of strain on their ability to issue debt.
Gotcha. I also wanted to talk about market structure. I co-host the GFICC show on Mondays, and we talk a lot about munis. There's always a lot of demand to talk about muni ETFs. What does the growth of muni ETFs mean for this industry? Is it the product that is stoking demand, or is it the asset class that is creating a demand for the product, for ETFs?
So if you look at the muni market, over the last 5 years, annual volumes have increased 125%. And where that has been most prevalent is in smaller lot sizes, so trades of less than $1 million. And what we've seen is a shift from traditional mutual fund demand to both ETFs. And if you look at ETF inflows, they're actually higher this year than mutual fund inflows, but also separately managed accounts. So because of technological advances, a lot of institutional money managers are now allowed to offer separately managed accounts to individual investors at scale, which means they can purchase $500 million of a municipal security, they can divvy that up in $100,000 lots, and then obviously that creates the smaller pieces trading around the market. So what we've had to do is, from a market structure perspective, is we've had to adjust our trading architecture to fit all of these smaller pieces and higher trade count going through the pipes. That requires enhanced algorithmic trading, ability to commit to more portfolio trading, as well as having the right pipes with all of our core clients.
All right, fantastic. Thank you so much, Matt.
Thank you.
Matt McQueen of Bank of America and Bloomberg's Michelle Kasky. Still ahead on Real Yield, my final thoughts. Fed Chair Kevin Warsh gears up for his first interest rate decision leading the central bank. That begins on Tuesday. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's now time for my final thought. We are less than a week away from the June Federal Reserve meeting and Kevin Warsh's first rate decision. With me to discuss now is Bloomberg's Mike McKee. And in terms of decision, the decision is there's going to be no rate change. We know that. But it will really be about the language in the statement.
Well, the language in the statement, but also much more probably about how Kevin Warsh handles himself. There's a feeling that the language is going to go, because we had the 3 dissents at the last meeting, and there is no call for a rate cut anymore. So they probably will take that out. That won't be very controversial. But the question will be, well, there'll be twofold question. One is the summary of economic projections, which leads to the dot plot. Do they make any changes to that? Because Warsh has said he doesn't like that. And does anybody leave in a rate cut later this year or next year? And does anybody put in a rate increase? Or is it just kind of left the way it was? But then how does Kevin Warsh handle the press conference? How does he describe what he wants to do? Because that's going to be the focus of all the questioning. And how does he handle maybe tough questions about some of the things he's said in the past? So it's going to be sort of, I've said this is going to be sort of like a movie review or a theater review for most of the news stories that you get.
What he said in the past has been that he doesn't necessarily want the Federal Reserve to be out there talking so much, whether it's Fed officials or even the news conference to be that involving. Do we get the sense that this could be a short press conference where he gives short answers and just calls it a day at that?
Well, he could give short answers. I don't think they'll shorten it in terms of the number of people who get questions, because it's mostly the mainstream media who all ask the questions, mainstream financial media who ask the questions. But it'll be interesting to see how he handles it. Jay Powell was much more off the cuff in the beginning, and then when some of the answers got tricky, he would have the binder in front of him with the language that they want to use. Will Kevin Warsh do that? That's going to be interesting. I don't think that he will say a whole lot about cutting back on speeches or appearances yet, because it's only been about 2 weeks. It took so long to get him confirmed. So he hasn't had time to really sit down and talk with everybody and develop a consensus about what they want to do. But again, it's going to be very interesting.
All right, we're going to get our popcorn out. Mike McKee, of course, will be on the scene in Washington, D.C., attending the FOMC press conference on Wednesday at 2 p.m. Or 2:30 p.m., because 2 p.m. is when the decision comes out. Thank you so much, Michael McKee. From New York, that does it from us. Same time, same place next week. Remember, we are on Thursdays now at 12 noon. Bloomberg Real Yield continues next week. This is Bloomberg.